Hello, my name is Macy Weir, and I'm here today to tell you why Walt Disney Company is not the most magical stock on earth. While there's no doubt that the company has solid performance lately, I believe that the stock is overvalued and would recommend a sell rating. Now, according to my analysis, which I will walk you through in a minute, there is a downside of up to 35.7%. Now, before I jump into this analysis, I'd like to give you an overview of the company. Disney is a household name with a strong brand recognition. They're one of the largest mass media conglomerates in the world with a diverse product base. They have four main segments of business, which are parks, experiences, and products. This would include theme parks like Disneyland that have rivals like Six Flags and their cruise line in addition. They have a traditional media networks, which consists of 8 broadcasting stations with 230 affiliates. Now, this is their bread and butter, like with channels like Disney Channel, Freeform, ESPN, ABC, and more. The third sector is direct to consumer, which includes merchandise sales, and finally, there's studio entertainment. Now, recently, Disney has acquired 21st Century Fox. They first offered around $50 billion for this company, but became involved in a bidding war with Comcast, and that pushed the price of the acquisition up to $71.3 billion, which you can see here on the screen. Now, that caused Disney to overpay for the company. And then they proceeded to buy Hulu from this same rival Comcast. Hulu loses about $1.5 billion a year. Now, Disney has plans to change this, of course, but that's going to require capital investment and time. If you look at Disney's stock price over the last year, even over the last 3 years, you'll see it's the same. The stock has floated around 110 price range. The major jump that you see here in that first little, the major jump that you see here and that first star is from their investor day and the announcement of their streaming service, Disney Plus. Now, this is something that they hope will rival Netflix, and I'm not denying that this is a good idea. It's definitely a move that Disney needed to make, but again, it's going to require high capital investment and potentially cannibalize their already poor investments with Hulu. Now, Netflix has been branching out into children's shows. They have the market share, and they have the brand recognition as a streaming service. So this move is going to add risk to Disney that they have not yet faced, and they're going to be a slow mover to this market. Now, in addition, Disney's stock fluctuates greatly with the season and timing of their movie releases. You can see the dip in the price in April 26 following their release of Avengers Endgame, which is not really what you would want to see following a big release like that. You'd hope that the stock would bump a little bit. Furthermore, Disney has lost key sponsorship in the past month. So now I will be moving on into more of a quantitative analysis of the company. I'll begin with the comparables analysis, and I'd like to preface this by emphasizing that Disney is a diverse company and it's difficult to find true comparables. So in order to account for this, I attempted to grab comps that would represent each segment of the business. So my base point for this analysis was the top 5 and the top 10 named competitors from FactSet. These gave me an enterprise value to EBITDA multiple of 7 and 7.81 respectively. Now, based on this analysis, the price per share would have been $53 and $63. So I definitely don't think that Disney should be valued around $50 to $60. I felt like these comps were inaccurate representations of Disney, especially with the new acquisition of Hulu and the added plans to have that streaming service to combat Netflix. So instead, I took the top 5 comps. I added Netflix, Six Flags, and Royal Caribbean to more accurately represent those other segments of their business that are not just movies and TV shows. In addition, I took out Viacom, and this resulted in a multiple of 9.79 with an implied value of $86.6, which you can see on this slide here. So moving forward, I did a discounted cash flow of Disney. Here you'll see a couple of my key assumptions. The tax rate of 21. This came from the 5-year average forecast. Bloomberg had a beta of 0.89 and a WACC of 7.3. So under these assumptions, I did do a DCF, which showed a small positive upside. However, I felt like this was not an accurate representation, especially considering that set of comps that we just looked at. When looking at their betas for Royal Caribbean, Six Flags, and Netflix, they were all much higher than that of Disney. In addition, Disney is now taking on twice as much debt than they've had in their recent history. So in order to account for this, I felt that the unlevered beta for each comp, for Netflix and Royal Caribbean and all of those, I took an average of those. This resulted in a WACC of 10.24%. And a potential downside of 46.4%. However, I didn't include that here on these slides because I'm showing you a base case scenario and wanted to be more conservative. So I took a weighted average of Disney's beta, including Netflix, to arrive at a beta of 1.02. So this was taking Disney's current standing beta, that 0.89, weighting that at about 80%, including Netflix at about 20%, which I do realize was slightly high, but with the purchase of Hulu and now this streaming platform, which a lot of people are putting weight into, the additional debt, I felt like that increased risk was necessary. So this resulted in a WACC of 7.93, which I used in this analysis that you're looking at now. So this gave me a stock price estimate of $125 with a potential downside of negative 6.55%. So to me, this number seemed a little more in line with the value of Disney. If you recall from the slide with their stock prices, they were struggling to breach that 120 mark. They were valued closer to 115 on average. So in light of recent reports and performance, I feel that Disney would be valued at over 120, but not quite 135. So because of this, I gave the DCF a higher weighting in calculating the expected stock price. This resulted in a price target of around 116, any potential downside of 13.84%. So in conclusion, I would just like to reiterate that Disney is a great company, but its stock is simply overvalued due to overly optimistic assumptions from analysts.